Hello everyone. In this video, we're going through the topic of valuation of property, plant, and equipment, PP&E. It's a relatively quick topic. There's just a couple of different things we have to look at, but they're all relatively straightforward. And some of these we've even kind of seen before a little bit. Okay. Companies do not always simply pay cash for the full amount of the asset's purchase price, which creates issues in valuation of the asset. Okay, so four situations that present valuation issues are cash discounts, issuing notes payable for assets, lump sum purchases, and then issuing assets, stock for assets. Okay, so basically we have four situations here where a company is not just straight up saying, oh, okay, here's some cash for a building, or here's some cash for a piece of equipment. Okay, and so because of that, we have some issues in terms of valuation of the asset, meaning how much do we actually capitalize the asset for? How much do we put the asset on the books for? Okay. So the first situation is cash discounts. When the company purchases an asset subject to a cash discount, the company should record the asset at the full purchase price less the cash discount. This is a little bit of a gray area. Okay. Now, we're going to see in the problem when we do it in a minute how this is recorded, and we'll talk about it a little bit more at that point, why it's a gray area. Okay. But again, basic rule is that we record the asset at the full purchase price, the full list price or whatever, less the amount of the cash discount that we would get. Okay, so basically we'd subtract the cash discount from the full purchase price. That's how much we would actually capitalize into the asset account. Then second, we have issuing notes payable for assets. Companies must record the asset purchase at the present value of the note given for the asset. This is done to reflect the current cash equivalent cost of the asset, the amount that you would pay today in cash to receive the asset. Okay, the idea here is that, we're giving somebody a note, right? A note's payable. We're going to pay them a certain amount in the future. Right, and so basically what's happening is that we're going to pay them, $200,000 or something in the future, right? That's not what the actual amount of that's not the amount of cash we're paying out today, right? It's the cash we're going to pay out in the future. So what we need to do is that we need to determine the present value of that note, and from there, that will be what the cash. If we paid cash today, that would be the amount of cash we would actually pay out, the present value of the note. That's what we're measuring, okay? And so that would be the current cash equivalent cost of the asset. That would be the amount we would pay in cash today to receive the asset, okay? We can pay $200,000 in the future, or we can pay $190 today, right, in cash, okay? And so that's equivalent in terms of time value of money, okay? Then we have lump sum purchases. This is the relative sales value method. It's a method of valuing assets when a company purchases multiple assets together for a single amount. This is referred to a basket purchase or lump sum purchase. This is actually from the topic when we talked about purchasing a bunch of assets together, but we're kind of just going over it again in this context of purchasing PP&E. Okay, so again, when we purchase a bunch of assets together, as an example, if a company pays $5 million for a building and the land the building is structured on, the company must divide the $5 million cost between the land and the building. The $5 million cost would be divided based on the relative sales value of the land and the building. The sales value is essentially the fair value or estimated selling price of the asset. So what we do is that we say, okay, we pay $5 million for this building. Then we have to determine how are we going to divide that cost between the land and the building. So the way that we do it is that we determine what is the sales value of the land, what is the sales value of the building, and then we do it kind of pro rata. If, the land is 60% of the value, then that means it gets 60% of the cost assigned to it. If the building is 40% of the value, fair value, then it gets 40% of the cost assigned to it. We'll see a problem with that as well. Okay. Finally, we have the idea of issuing stock for assets. So again, companies must record the assets purchased at the fair value of the stock issued for the asset. This is, again, done to reflect the current cash equivalent cost of the asset, the amount you'd pay in cash today to receive the asset, right? So if the fair value of the stock is $100,000, then that is the amount that we're going to record the asset at, because that's basically what its value is, right? That's the amount that we would pay in cash, right? Because alternatively, what we could do is we could issue the stock for $100,000 to the market, get $100,000 of cash, and then give these other people that we're buying the asset from $100,000 of cash. Okay, so that's basically just a measure of the cash. Okay. So now let's go through a few quick problems. None of these are all that hard. They just have a couple of notes that we have to go through. On January 1 of 2017, ABC Company purchased a piece of equipment on account to use in its manufacturing center. The equipment cost $100,000, was subject to credit terms of 210 net 30. ABC pays for the equipment on January 13th of 2017, so they pay past the discount period, right? Because it's 2/10. They have 10 days, right, from January 1st. So they're like 12 days past the initial date, which means that they do not meet the period for the credit terms to actually get the discount, okay? So prepare the journal entry for ABC to record the purchase of the equipment and the payment of the accounts payable. Okay, so the first thing, like we said before, we're going to record the asset at the full purchase price less the discount. Okay, so what would that mean? That would mean 100,000 minus 100,000 times 2%, right? Because again, we're taking out this cash discount. Okay, we're not going to be able to record it at the full 100,000. We're actually going to have to take out the cash discount of 2%. Okay, that gives us 98,000. So then we just debit equipment for 98, credit accounts payable for 98. Okay, because in this case, we're kind of assuming that we're going to take the discount. We're assuming that management is not negligent and they're not going to screw up and not take the discount. However, management does fail to take the discount. Okay, and so what happens is that people will say, okay, when you're paying off the accounts payable, you have to pay cash of 100, right? Because you don't get this discount anymore. What happens is that you debit accounts payable for the full amount, 98, that we put on there. Then we have to debit purchase discount loss. If we kind of remember back to when we were recording inventory, this purchase discount loss is when management thinks that they're going to take a discount and then they don't. They fail to take a discount. And so we're not going to actually capitalize that into the cost of the equipment. We're going to record that as like a loss, okay? Because people might say, oh, well, you pay cash of 100,000. Well, shouldn't you record 100,000? Well, yes, if there wasn't a cash discount, right? Because in that case, it's a situation where you would have actually paid 100,000. It wouldn't be because of management's negligence that you didn't take the discount, right? If there wasn't a discount to take, there would be no management negligence in that case, right? The reason I say this is a gray area is because I'm covering it in this specific way where you're always just going to record the asset at the full purchase price less the cash discount. Some people, it depends on the way you look at it. Be careful with your professor. I would check with them and see what they would like you to do in this case. Some professors might say to record it in this way where you always just record it net of the cash discount and then you never adjust it. Some of them might say, well, if you pay $100,000 of cash, you really should, instead of purchase discount loss, you might want to put equipment here or something like that. Okay, it just depends. That's why it's a gray area. There are technically different ways of doing it within GAAP. People within practice do it different ways, okay? The way I did it here is probably the most theoretically sound. It's probably the most correct way, and I would say most people would probably agree with that. However, it just depends on your specific professor or your specific class. Okay, so make sure you check there. That's why it's a gray area, because technically you could, in some cases, some people would argue that you could debit equipment here and actually increase the cost of the equipment because technically you are paying out cash of $100,000. Okay, so that's for the cash discounts. Then we're going to go down to issuing on notes payable for an asset. Then we have on January 1st, XYZ company purchased a piece of machinery to use in its manufacturing center. The company paid for the machinery by issuing $150,000 notes payable that pays interest annually at 10% and is due in 2 years. The current market interest rate for the notes payable, or for notes of a similar nature, is 11%. Prepare the journal entry to record the purchase of the machinery. Okay, so basically this thing about the notes of a similar nature is 11%. That's telling you the market interest rate, okay? So we have the stated rate, which is 10%. We have the market interest rate of 11%. We can determine the present value of the note, right? And that's what we need to do. When we're actually recording these, again, as it says on the first page, okay, of this packet, companies must record the asset at the present value of the note given for the asset. Okay, so we're trying to determine the present value of the note, and once we determine the present value of the note, that's going to be the amount capitalized into the equipment account. In this case, it's 147,431. We'll go through the calculations in just a minute, okay? Then we always, whenever we put a notes payable on the book, we always credit notes payable for the full amount of the notes payable. Okay, so it's 150,000. Then the difference between notes payable and equipment goes to something called discount on notes payable. If you look back on the notes receivable, it's very similar, okay, to that. Whenever we have a notes receivable, it's issued at a discount. We also have a discount account there as well, okay? This is just to state the notes payable at 147,431 because that's what it was issued for, okay? So to calculate this for time value of money, we put NS2, interest rate, I/YR is 11, payment is 15,000 because this is just 150,000 times 10%, right? The stated rate times the principal, stated rate principal. Future value is 150,000, gives us present value of 147,431. Okay, so that's how we solve. That's how we solve a problem of issuing notes payable for assets. Okay. Then we have the relative sales value. Okay, approach. XYZ company recently completed a lump sum purchase where it bought some equipment, some land, and a building for $200,000 cash. The following information is available concerning the equipment, land, and building. Then we have our items and we have our estimated selling price. And again, what we're doing here is that we're using these estimated selling prices to determine the cost that we're going to allocate to each item. So we prepare a journal entry. We're going to prepare a journal entry to record the cost of the equipment, land, and building for XYZ. Okay. So what we want to do is we want to set up a chart. Okay. What we want to do is we want to put all the items, and then we want to list the estimated selling prices, because what we're going to do is that we're going to use these to actually allocate the cost. Okay. So we just list out 600,000, 700,000, 1.2 million, and then we just total it up. Okay. We literally are basically just copying that chart down here. Then the next step is to determine the relative sales price. Okay, this is the method. That's what it's called, relative sales value. Okay, so what we do is we take 600,000, we divide by 2.5 million. That gives us 0.24. Then we get 0.28 by dividing 700,000 by 2.5 million. We get 0.48 by 1.2 million by 2.5 million. Okay, that adds up to 1, which is what we would expect, right? And basically what this is saying is that the equipment is 24% of the total fair value of all of these different things. Okay, so that means that, and it's the same thing, 28 and 48% for the other two. That means that specifically for the equipment, it should be allocated 24% of the total cost, right, that we paid, because that just kind of logically makes sense, right? If it's 24% of the value, it should be 24% of the cost allocated to it. So then what we do is we take 24% and multiply it by 2 million to get 480,000. And then we do the same thing for the other two, multiply 2 million times the percentages, and we get the values, okay, for them, 560 and 960. Then the journal entry comes from right here. It comes from this last piece here. Equipment is 480, land is 560, building is 960, cash is 2 million. Okay, so basically the steps are to figure out the estimated selling prices they're usually given, determine the relative sales price, and then just literally multiply that by the total cash price that's paid. That gives you the cost allocated to the items. And then from there, you just make the journal entry, okay? Which is probably the easiest part, just debiting some assets and then crediting cash, okay? Finally, we have stock issued for assets. This is our last little valuation issue. February 2nd, 2017, ABC Company purchased a building from company XYZ by issuing 100,000 shares of its common stock that had a fair value of 500,000. The par value of the stock was $1. Required, prepare the journal entry for ABC to record the purchase of the building. Again, what we're doing here is that we're going to record the building at the fair value of the stock. That's our rule, because we're trying to determine what is, because again, we could issue this stock, get $500,000 of cash, and turn around and pay $500,000 for the building. So that's the current cash equivalent cost of the building, right? The fair value of it. Okay. So again, we debit building for 500,000. Then we just have two credits. Common stock is for the par value of $1 times 100,000 shares. It's always, the common stock account is always just debited for the par value times the number of shares. And then additional paid in capital is the difference between the amount that you debit to building and then the amount that goes to common stock. That goes to additional paid in capital. So anything that is over and above the par value of the stock. Okay, so that's the end of this topic, and I hope that was helpful.